where to begin. I think I'm guilty of not reading the news this morning because we've been trying to get this event in line for the 1,100 or so delegates. But from what I understand, there's been a bit of a U-turn around the mini budget. But I think, just taking the more broad themes of where we think the economy's going, I mean, a rise in interest rates has a number of impacts on the hospitality industry. I think from a demand point of view, we've seen rate grow really strongly over the course of the last 12, 18 months as we've come out of the pandemic. Is the rise in interest rates going to be the end of that? And the reason I say that is because a rise in interest rates clearly has a big impact on the consumer in terms of mortgage costs, for example, which is probably one of the largest costs for most people out there in the UK right now. So an increase in the cost of in interest rates and mortgage repayments will have an impact on the amount of discretionary spend that people have to deploy on all kinds of things, from retail to all of the different experiences that you can think of. I mean, one of the positives from that is that hotels, travel, hospitality has been taking more than its fair share of that discretionary spend. So let's hope that continues and perhaps even grows a bit to offset what we think might be a bit of weakness around the consumer moving forward. So that's that sort of demand point of view. I mean, from an investment point of view, clearly rising interest rates means a rising cost of capital. So it's going to be harder for a lot of investors to get the returns that they require to surpass their hurdle rates when they're looking at investment opportunities. And I think that's kind of has a bit of an impact which is twofold really. It means that those that have stock or that are acquiring stock now will really have to think about the asset management piece. How can we juice and sweat the asset even more to lift our returns and make sure that we're exceeding that greater cost of capital? The other point that if you haven't invested yet or put your capital to work yet, and you can't see the asset management opportunities, then the likelihood is that rising interest rates will translate to a softening of prices. So the value of hotels, either on the market or existing assets that are being valued by the real estate advisory firms, will probably see a bit of softening around that because of the rise in interest rates. And the other thing that then does is around development. We know that the viability gap is large and has been growing with rising build costs. But I think if we start to see a softening in values as well, it becomes even more difficult to develop new stock because it's costing you more to develop, and what you're going to get at the end as a developer when you come to sell is going to be lower. So that viability gap is widening, and it'll be interesting. I know we've had a bit of public sector intervention on some projects to drive a regeneration agenda, for example, but it kind of remains to be seen as to whether that will continue and grow, and if it doesn't, what we'll see is a tempering of the development pipeline in the UK, which for existing owners, great, because we could well have a benign supply landscape going forward for the next 3 to 4 years before we start to see a more normal market kind of condition come back into play. Well, I think from an underlying demand point of view, and I've touched on it already, but we are spending a greater amount on experiences, on travel, and that's going to continue. Experience is the new social currency, right? It's not your tangibles anymore. It's your Instagram posts, and it's traveling to some wonderful place and staying in a great hotel that's really Instagrammable, and you can share that moment, that memory with your friends, as well as experiencing it firsthand. And as I say, that's going to continue. I think the percentage of discretionary spend that is spent on experiences and hotels will only continue to grow, probably to the point when you could question whether travel, hotels, is it discretionary? I think we all feel that we owe ourselves at least one holiday a year, right? So maybe that's been flipped on its head as well. I don't want to get into the weeds of that, but something quite interesting to be debated for sure. So I think that's from a demand point of view, which gets a lot of investors very comfortable and somewhat excited about the sector. And then you look at hotels on a relative basis, and if you're an investor putting your capital to work in real estate, take a look at some of the more traditional asset classes. Office, who knows what's going to happen with the return to work? Are we going to end up with a lot of redundant office buildings going forward? Quite possibly. I think it's very uncertain in that market right now. We know that retail continues to be challenged. It has been for a number of years. The rise in e-commerce. And then you look at industrial and logistics as well, and we've certainly seen a little bit of a peter off in terms of values in that space as well, and probably more demand historically than we've had supply, but that dynamic again is starting to shift. So a lot of capital looking for a home, looking to be put to work. Where does it go? We've got the alternative property types, of course we have, but hotels stands out as being by far the most liquid, the most transparent, the most professional of those property types. So if you're a very traditional institutional investor that's looking to put cash to work and you're looking at the alternatives, hotels is a great place to start. And we're seeing a lot of that. Here at the conference today, we've got the likes of L&G, Aberdeen, very core pension funds, annuity funds. Historically, they've maybe looked at hotels only on a leased basis. They're now starting to move into operational exposure, moving along the risk curve, getting themselves educated and savvy and ready to deploy more capital into this space because they believe in it. And again, I think it all comes back to the fundamentals. And that will be supported by, potentially a more benign supply environment going forward, as we've discussed. The fact that your replacement costs sit much higher than what asset values sit at right now. So a number of very kind of key fundamental and attractive drivers into the space, which is continuing to pull capital our way. Hopefully the whole inflationary beast will start to be tamed somewhat over the course of next year, and I think we've had an economist this morning that said they expect the inflation rate to be closer to 5% by the end of next year to the 10% we're seeing now, which clearly will relieve some pressure, hopefully, on the consumer, spark a bit more demand coming back into the market, which hoteliers will be able to leverage. But in the same vein, we've also heard from Hot Stats this morning, who showed a great sample P&L where they've tracked a comp set of hotels over the last 12 months that have actually, as a collective, driven a £250,000 growth on the top line in terms of revenue by leveraging all of that increased demand that we've seen recently. But on the bottom line, they're actually down £250,000 because of the rising operational costs, which is a swing of 500k. That's very challenging. So I think that operational pressure is probably going to remain there for some time for the operator. And you would question how much leaner a number of operators can make businesses, how much cost is there left to cut. I would argue not a great deal. So we'll certainly see the impact of continued rising costs, for example, on the bottom line. And if we see a slowing on the top line, then that could really kind of start to see some pressure building around some of the operators out there in the market and some of the owners. I think certainly then the owners that are coming up for a refinance sometime soon and facing this big increase in interest rates, that's going to create some real challenges as well. We've seen a number of lenders that have stepped back a bit from the market, adopting something of a wait and see approach, which is to be expected, but it makes it very hard for those coming out looking for finance right now to find a suitable partner at a relatively kind of reasonable interest rate, shall we say, that's manageable and sustainable going forward. So, are we going to see some distress in the market? I think actually it's probably inevitable, and there's still a lot of owners that have a relatively large amount of leverage coming out of the downturn. Yes, we've seen a pickup in top line, it's not been reflected on the bottom line, so it's not like we've got a lot of working capital kind of swelling around for to pay down debt or to reduce some of that leverage. So I think there's a potential for a bit of hurt going forward. We know there's a lot of funds out there that are waiting in the wings, ready to pick up stock that does unfortunately kind of fall into something of a distressed situation. So lots to be seen over the course of the next 12 months, but I think those will kind of be the key trends. If I put myself into a seat where I'm thinking about what the program looks like this time next year, is there a session on there about distress and opportunistic investing? I think there probably is.